Hello, and welcome to the Krish Kothari Show question and answers episode. I want to start by thanking everyone for all their questions. We've got some really interesting, fascinating questions that you guys have sent. I should add, though, that we get a lot of questions, basically one way or another, asking for investment advice, which, as you can imagine, we cannot give you. So I'm afraid we can't answer those questions, but we do try and find the most interesting and what we think are the most relevant questions and try and answer those. But please keep sending them in. We are really happy to get them. You can send in your questions to tkksquestions@gmail.com.
As always, nothing in this video is investment advice, nor a recommendation to or not to buy, sell, or hold any security. We're happy to partner with the Zero On Media Network to bring you useful and interesting insights and information from the world of business and investing. So go ahead and like, subscribe, and hit the bell icon.
We have three really interesting questions today. One relating to equity investments in unrelated companies by listed companies. Another question on debt funds, which I think is a question a lot of people have. And it's a really important question. And I think a question that people will have to deal with a lot in coming months and years. But we begin with a question on what I think is one of the most important corporate developments in recent months, the acquisition of Akzo Nobel's India operations by the Jindal Group. Akanksha asks, does the Jindal takeover of Akzo Nobel signal an M&A race in the paints industry? Could more companies be bought in that space? As I'm sure all of you know, Akzo Nobel's India operations, minus a couple of smaller components of that operation, have been sold to the Jindal Group in a very large, multi-thousand crore deal. The paints industry has, been under the spotlight quite a bit in recent years because there's been this sort of 180 in the competitive landscape where you had, for many years, there was essentially one very large player and everybody else was basically fighting for second place. And suddenly you have this situation where there's multiple large players with deep pockets who are in a position to very aggressively fight for market share and distribution. It's not a surprise that Akzo Nobel was happy to offload the India business. It's not a business, the India arm, that has, particularly shot the lights out for many years now. It was basically fighting for third, fourth place in India and targeted a section of the paints industry in India that wasn't necessarily the most attractive part of the entire space. So it's understandable that the global parent basically said, we are probably happy offloading our shares. Maybe there's more we can do with that money as far as core operations and core markets are concerned. From Jindal's perspective, it's an understandable move. It gives them immediate distribution. It gives them an existing base of clients. And like I said, because Akzo was an important player in specific segments of the paints market, it gives them access to certain areas they otherwise would have taken many years to build out distribution, build out market share. So it's, in a sense, just accelerated growth in what otherwise would have been non-core paint markets in India for the Jindal Group. The fact that the Jindal Group targeted Akzo is also not surprising because you think about the large paint companies in India, and they are generally listed companies. And who's really for sale? It's tough to make the case that Asian Paints is for sale for obvious reasons. Then next is Berger, where, probably not for sale. And even if it were, it would be such a large transaction that it may not make it's probably cheaper for Jindal or Birla or anyone else to build that out over time. The third other large option is Kansai Nerolac, where again, maybe there is scope for something to happen, all probability an unlikely seller. Then you have smaller companies, you have Circa Paints, Indigo Paints, which is probably the next large one. Again, not clear that there is any obvious desire to sell on the part of existing promoters or existing shareholders. So in a sense, Jindals have probably taken the one obvious M&A candidate off the table by acquiring them. And obviously that has strategic value in terms of the fact that they own them now means nobody else can own them. And like I said earlier, that it gives them immediate distribution and, sort of dominance or at least large market share in certain niche areas of the paints industry in India. The question of whether this signals some larger consolidation in the space, I'm not sure that it does. We have seen in many industries around the world that one large M&A does, rightly or wrongly, trigger a lot more M&A, whether other companies do it just because they feel the need to protect their own market share, whether they feel that consolidation is now inevitable, so therefore they want to be beneficiaries of that rather than victims of it, and therefore they feel the need to start acquiring or maybe even get acquired. And I think that if this does trigger any form of consolidation, it may be actually for the latter rather than the former. That is, it may signal to smaller pain companies that their best bet of surviving and thriving is actually going hand in hand with some of the larger players. So it wouldn't surprise me if some of the smaller guys take that call and say that, it's going to be tough to survive on our own because the competitive landscape is just not what it was even, say, 5 years back. It's going to be harder to get distribution. It's going to be harder to maintain distribution. Working capital cycles we have to worsen. We have to spend so much more on marketing, branding, advertising. Taking all that into consideration, rather than entering this sort of warfare in that space, we're maybe better off just partnering up with one of the larger guys. And that may actually trigger a certain amount of M&A. Like we discussed earlier, there really isn't much up for sale. So if anybody else is wondering whether or not they should do an M&A, and if they have decided that they do need to add some heft in the form of consolidation, they may very quickly run out of potential candidates. And so therefore, I don't think it's out of the realm of possibility that we may see one more transaction in the not too distant future where another large player, whether it is an incumbent or one of the relatively newer companies in this space, goes out and acquires an existing player, whether that player is of a similar size of Akzo Nobel in India or maybe a little smaller. Of course, who knows, and only time will tell. A very interesting space. Akanksha, thank you for that question. Our next question is on mutual funds and specifically debt mutual funds. Jacob D'Souza asks, is it possible to lose money on debt funds? What are the risks debt fund investors face? A lot of investors in mutual funds today are now debating whether or not they should be transferring some amount of their holdings in equity funds, particularly funds focused on mid caps, small caps, and move it into what are generally seen as relatively safer plays. So that could be debt funds, hybrid funds, maybe even FDs in some cases. If you've taken the call to buy fixed income or debt funds, it is really, really important to know what you're buying, but also the risks that you face when you invest in those funds. Now, in debt funds, there are some really, really important risks to keep in mind when buying them. I know that people generally just conflate them with riskless investments, but they aren't riskless. Let's imagine that I am lending money to a company. Now, what is the ultimate risk? The ultimate risk is that the company I've lent money to is unable to repay me, and therefore my capital that I've given them, the principal that I've given them, isn't returned to me, or at least not in its entirety. The second risk, of course, is that they aren't able to service their debt. So the debt payments pile up and therefore the debt keeps ballooning. Now, debt fund risks are not really any different from that. Ultimately, what a debt mutual fund is doing is buying, subscribing to, holding debt securities. It could be debt securities issued by governments, whether it's a national government, state governments, or entities associated with the government or the state in some form. Or, of course, it could be lending to private entities, banks, all sorts of companies, generally all sorts of companies need constant financing. And therefore, the minute they lend out that money, there is a risk that the company or entity to which they have lent out that money is unable to repay them principal and or interest. So let's take, for example, a corporate bond fund, where essentially what the mutual fund is doing is buying, holding, dealing in bonds issued by private companies. So the risk ultimately is what many may consider tail risk, but what we have seen is not as much of a tail risk and is actually a much more real risk than a lot of people appreciate. The risk that the entity of which they hold bonds is unable to service that debt and therefore defaults, and the value of those bonds or those securities essentially decline and potentially go to zero. So there have been some high-profile cases of that over the last decade. I don't want to name any companies, but I think that they're fairly obvious cases that most people would know of in the last decade. And of course, if you go back further, there's, a laundry list of cases like this. So the failure of a bond issuing entity to service its debt, the first most obvious risk, and anyone who invests in a debt mutual fund, they have the risk that they will not repay the principal and or interest, and therefore the value of those bonds decline, causing very real loss to mutual fund debt mutual fund investors, and that loss shows up in its NAV. And that is actually why, after a few high-profile cases, regulators have created segregated portfolios or scope for segregated portfolios to deal with that. And that's a slightly more complicated thing, and I'm not going to bore you with those details and why there is a technical reason for mutual funds to do that and create those segregated portfolios. But the fact that those exist is a function of the fact that there is very real default risk. The second really important risk to understand when it comes to debt mutual funds is interest rate risk. Now, basic finance 101 tells us that a rise in interest rate causes a corresponding decline in the value of securities, equity and or debt. So based on the tenor or duration of debt, they may be more or less susceptible to changes in interest rates. And when it comes to interest rate risk, that is why the duration of your fund is absolutely critical. At one end, you have overnight funds, which basically lend out money on an effective daily basis, and so therefore are largely insulated from interest rate changes. At the other end of the spectrum, you have long duration funds, which hold securities with outstanding durations of multiple years, maybe even a decade. And those are extremely susceptible to interest rate changes and interest rate risk. So when you buy a mutual fund, the two primary risks that you face as an investor in a debt mutual fund are credit risk, which is the risk that the repayment of principal and interest doesn't take place, and therefore there is loss of capital. And the second is interest rate risk, that the value of your securities, which are the underlying securities which ultimately your debt fund owns, the value of those underlying securities falls as a result of changes in interest rates. Now, the way to get around that is there's broadly a couple of ways to do that. The first is you stick to very short duration, low duration mutual funds. So like overnight funds, liquid funds, ultra short duration, money market maybe, where because securities are held in those funds for a year or less, you tend to be largely insulated from interest rate changes. And of course, the shorter the duration, the more insulated you are from those interest rate risks. The second alternative is actually to buy what are floating rate mutual funds, where the rate is linked to changes in interest rates, and what it's linked to may vary depending on the fund and where you are in the world. But largely, the rates that you earn go up and down with changes in interest rates. So you are, in a sense, to a certain degree, locking in a certain return. Obviously, it's not foolproof, and it's not that the entire 100% of the investments are made in floating rate instruments. So there may be some amount that is still invested in fixed rate instruments that are susceptible to interest rate variations. So therefore, you don't necessarily get entire downside protection or upside reward, but it does to a large extent insulate you from interest rate risk. So those are the two, these are the two risks that you have to keep in mind. And these are two ways you can sort of protect against that. Of course, an important caveat to all of this is the returns you make are a function of the risk you're willing to take, in a sense. And in a very broad sense, the longer the duration, the riskier they are in terms of interest rate risk. And therefore, you are supposed to be remunerated in the form of higher returns. So what you'll see is an overnight fund may make, say, 5%, 6% over time, whereas a corporate bond fund or a long duration fund may have, make 7, 8, 9, even 10% over certain periods. And essentially what that's doing is compensating you for that additional risk that you're taking. Thank you for that important question, Jacob. Ramesh More asks, why don't more companies do what Bharat Bijli has done and buy large holdings in other unrelated public companies? It seems so obvious that this would improve the balance sheet and increase other income. So Ramesh, thank you for that question. Yeah, really interesting question. And I think a question that, a topic that doesn't get discussed as much as it should, which is what do listed companies do with their cash holdings? So the company specifically that Ramesh is talking about is Bharat Bijli, which is a listed public company listed on the Indian exchanges. And what's maybe most interesting about the company is actually not its operating business, but equity holdings that it has. Significant portion of their market cap is actually shares they own in two very large unrelated listed companies, HDFC Bank and Siemens. What you would see with most companies is that whatever holdings they have of cash are generally held A as cash or B as in what are seen as very low risk debt instruments or fixed income instruments. So they could be fixed deposits, overnight funds, liquid mutual funds, or relatively shorter duration, say for example, money market mutual funds. This is with good reason, actually. For most companies that have running operational businesses, their core function is not sitting and trying to figure out which other companies in unrelated fields going to do well over the next 5 years, 10 years, 15 years, and then trying to profit from that by buying shares in the way that, say, a retail investor would. Which is why most companies through their charter documents are largely prohibited from investing corporate funds in anything that is seen as a risky investment. But there's two primary concerns that I have with companies following this path. One is it's diverting management attention from what should be their core focus, which is the actual underlying operating business. And they shouldn't be sitting around debating, should I be buying bank X or bank Y or IT firm A or IT firm B or pharma company C or pharma company D, unless you are a firm that is primarily focused on investments. This is not how you should be spending managerial time. The second is that the primary use of your funds as an operational business is investing in your business itself, trying to figure out ways that you can use your capital to grow your own business. Or if you feel that there aren't adequate ways to do that, paying out that money to shareholders, whether that's in the form of dividend or buybacks. The core point is that money's primary and in some sense sole purpose is to fund future growth of your own operation. When I buy a operating business, I am buying it for the operations of that business. If I'm an investor and I'm evaluating a company and I have to now wonder, they're going to make some money, and then I'm thinking, okay, they're going to reinvest it in that business because let's say I buy a chemical company and I think they're going to make some money with with the assets that they currently have. They're going to take that money and reinvest it in more lines, more products, increasing distribution and things like that. And then it turns out that they are now speculating in the stock market and buying shares in a bank or buying shares in some completely unrelated business. That's not why I bought shares in a chemical company. If that's what I want to do, that's why I buy a mutual fund or a PMS, or I start doing F&O trades in my free time. That is not the reason you buy a operating business. And I think the first point, which is that it takes away managerial attention from the core operations, is absolutely critical. Imagine a situation where a company has invested money in unrelated equity and suddenly it's March of 2020 and those holdings are down 60%. And it's at those critical moments where the company actually needs the money, where they need to to pay employees without sufficient revenue coming in. They need to pay for working capital. They need to keep the lights on. Maybe it's even a chance to do an M&A deal at better prices. It's a chance to invest at better prices. And the money that you thought you had is down because you bought shares in some other listed entity. That is not what you get paid for as the CEO, CFO, CEO of an operational business. My goal is not to criticize the company that Ramesh has spoken of. Obviously, in their case, it's worked out. I don't know that this is a model that a lot of other companies should follow. Companies do on occasion invest in mutual funds and things like that have equity holdings. And of course, when times are good, it does reflect in higher other income. But like I said, unless you're an investment company or a holding company, maybe, other income is not what you're going for. What you're going for is growing your core operation business, cleaning up your balance sheet, improving cash flows from operations, and of course, ultimately growing the operating business. So I think, to answer your question, Ramesh, I think that is why most companies don't do it. And that brings us to the end of the episode. A lot of fun doing these episodes. I really enjoy the questions. Some really interesting questions. Unfortunately, some questions that we can't answer for obvious reasons, regulatory reasons. And some, well, it's, some of the things we don't answer for self-imposed reasons. But keep your questions coming in, tkksquestions@gmail.com. Send them in. We will hopefully get around to all your questions over time. Thanks for tuning in and see you next time.